This is a continuation of the previous video. In the last video, we looked at the calculation of cash operating profit, and we have found this out to be 16,000. I'm going to write that number here. 16,000 is the cash operating profit. However, there are working capital changes which need to be made to this number to reach at the final number, which is cash flows from operating activities. Now, what are these working capital changes and why do you need to adjust for these working capital changes? You see on the screen the balance sheet associated with the income statement, and let's talk about working capital. We know that working capital refers to the money which is temporarily blocked in the business. Now, where do you block the money? You block the money in current assets. How do you block the money? You buy stock and the stock is unsold. The money is blocked. You have bills to be received, bills receivables, which means goods have been sold and money has not been received, and which is also called debtors, but there can be some differences in these two, but typically companies club everything and they say receivables, right, or trade receivables. So money has to be recovered from the customers or people to whom we have provided services, and this money has not been recovered, but you on the other hand have paid for it, so money is blocked here. Then you could have prepaid expenses. Prepaid expenses meaning money has been paid for it, services are still to be received. We have paid it in advance. So again, money has been blocked here. And finally, you have cash and bank balance. But right now, the statement that we have in mind is cash flow statement. That statement will explain this change. How did 5,000 come into being? And this is 2019 and 20. That's why I'm going in this direction. In the last year, cash was 15,000. Now cash is 20,000. Why? That's what we are after, right? So in the working capital changes, current assets actually use up your funds. On the other hand, current liabilities, for example, you have creditors here. The creditors actually give you some cash. I mean, does that happen is you purchase from your vendors and you don't pay them. That's kind of saving the cash. You would have paid them, but they said okay, pay us after 2 months. So you have received that cash for 2 months from the creditors. You can also think of it in the following way: you purchase goods from the creditors, you paid to him. Now cash has gone out, and then creditor comes back and says, hey, take this cash back, pay me after 2 months. So creditor has given you this cash for 2 months, you can use it, and then when you recover from your customers, you can pay to the vendor. Just to think of it like that. You don't pay to the vendor and then it doesn't come to you. It doesn't happen like that. Okay, so creditors, or if there are outstanding expenses. What are outstanding expenses? When you do not pay after the expenses have become due. So when you do that, you are saving that cash with you. You're not paying it out. It's a liability as well. So this is how we think about current assets and current liabilities. Current assets kind of block your money, and current liabilities provide you some money. So the idea is to convert current assets into cash as soon as possible. You do want to sell the stock, you want to recover the money, you want to get the services for prepaid expenses. So this is what is referred to as working capital. Now, what are working capital changes? That is the next question. Now, working capital changes, let's start with again current assets. Unsold stock. Unsold stock, in this case, we have, let's start with the debtors here. We have debtors, so receivables. Receivables were 20,000. So from 20,000, now the receivables are 16,000. What does it mean? Last year, when you started the financial year 2019, 20,000 rupees were to be recovered from the customer. At the end of the financial year, only 16,000 need to be recovered. There is a change of 4,000. There is a reduction of 4,000. What does this mean? This means we have recovered this amount. In the beginning of the year, you were saying 20,000 has to be recovered. Now you're saying only 16,000 has to be recovered. So during the year, you must have recovered 4,000 in cash. That means this is a cash flow which has not been shown anywhere. So that's why we need to make working capital changes. We need to say that we have recovered money from the debtors. Decrease in the debtor results, decrease in the receivables results in cash coming in to the business. So decrease in receivables is decrease in current assets, and that is an inflow. So here in the working capital changes, decrease in current assets, I'm going to write receivables or the debtors here. Decrease in current assets or decrease in debtors equal to 4,000. This needs to be added to the cash operating profit because receiving from the debtors is also operating cash inflow. You sold the goods. This is operating income and this is cash income, so we should show it here. All right, then you have, so we've done debtors. Let's look at bills receivable, which go up from 2,000 to 6,000. So bills receivable were 2,000 and now they are 6,000. There is an increase of 4,000. What does this mean? This means bills were to be received 2,000 and now there are 4,000 rupees worth of more bills which need to be recovered from the customers. Meaning you actually did not receive this money. There is more money to be recovered. These bills you must have paid, on your own and now to be recovered. So this 4,000 actually the increase in the the increase in the debtors is an outflow of cash for the business because you paid for these bills, but your customer has not paid you these bills. So 4,000 increase in the current assets. I will write bills receivable 4,000. This needs to be deducted. It says less. So if you notice, any decrease in the current asset is a source of cash. So this is a cash inflow and that's why we are adding it, and any increase in the current asset is a cash outflow and therefore we are deducting it. As discussed earlier as well, the current assets, when you create more current assets, you are blocking your money. That's an outflow of cash and that's exactly what we are making adjustments for. The third current asset that you have is prepaid expenses. Prepaid expenses are going down from 3,200 to 2,000. So any decrease in the current asset is a source. So I'm going to write prepaid expenses 30. So it actually the difference is so it is going down by 1,200. So I'll write 1,200 here. It's a source. Okay, and I'm going to do a separate tutorial on understanding these changes and classifying them as an inflow or outflow as well. So look out for the following videos where I discuss these things in detail. All right, now let's move on to current liabilities side. You have creditors. Creditors are going up from 2019 to 20. We are moving from right to left because the financial years are shown in that way. There is an increase in the creditors. So it means 12,000 were to be paid to the suppliers. Now 18,000 need to be paid to the supplier. There is an increase of 6,000 in the money to be paid. If money to be paid has increased, that means you did not pay for it. That means you saved that cash and hence is an inflow of cash. So increase in creditor or increase in current liability is also a source of cash. So creditors are going up by 6,000 and we are categorizing this as a source of cash. I'll write cash inflow. You don't have to write it, but just for your information right now. Then you have outstanding expenses. They were 7,200 and now they are only 5,500. At the beginning of the year, you had to pay 7,200 rupees worth of expenses. Now you only have to pay 5,500. How? You paid some of the expenses. How much? How many expenses did you pay? 1,700. 1,700. This is a decrease. So if current liability is going down, that means you met the liability. You have paid for the liability. So 1,700 is decrease in current liabilities, bills payable. This is a cash outflow. Cash outflow. That's it. Now we have adjusted for working capital changes. There were changes in the current assets, current liabilities. Some went up, some went down. Accordingly, we treated them either as inflow or outflow, and now we have adjusted those. So this number now gives us cash generated from operations or cash flow from or used in operating activities. So here all we have to do is sum this up. This is 20,000, this is 21, 200, this is 27, 200. Now you deduct from this 5,700 and you have your cash flow from the operating activities. This comes out to be 21,500. Hoping the math is correct. 21,500 is your cash inflow because this is a positive number. We don't have to write this now. So cash flow from operating activities. This is the section A of cash flow statement of this sample company, the example that we are doing. So there were two steps involved in preparation of the first section of cash flow statement. So cash flow statements section A, which is cash flow from operating activities. Just to summarize, the first thing is cash operating profit that you calculated, and then you made some working capital changes. That is the overall structure, and this gives you the number which is cash inflow or outflow from the operating activities of the business. This is result of section A. And that's it. I'll see you in the next video. There are a bunch of tutorials which I'll do to help you understand the preparation of this first section a little bit more. And this first section is the most complicated of the three. Once you do this, the other two sections are going to be very easy. I'll see you in the next video.